New all-time highs in equity markets also for 2025? Is this even possible with ongoing wars, Trump? Of course, the risk of a market correction is always there, and risks are there enough also in 2025. Ongoing wars, geopolitical troubles, potential trade war of Mr. Trump, etc. But maybe 2024 is a good example. We had plenty of geopolitical risks, a Trump election, ongoing wars, and nevertheless, it was a very good equity market year across the globe, even in Europe. How is this even possible? Well, if you look at fundamentals, the world economy also in 2024, despite all those troubles, was growing. This might sound strange to Austrians, where the economy has been shrinking now for more than 2 years. The same in Germany. But the rest of the world has even been growing in 2024, even the euro area. If you have a look here at the chart, the euro area in total in 2024 was growing by 0.7%, roughly, approximately. The rest of the world even stronger, for instance, the US. So company earnings have been increasing. What would you expect equity markets to do when companies are earning more? And, which was also happening in 2024, interest rates are coming down at the same time. This is quite a good environment for rising equity markets, which we saw in 2024. So let's have a look at 2025. Can these real driving factors, fundamentals, continue? And here I think there's room for optimism. The world economy is rightfully expected to grow further next year. Just think of it. Interest rates have now come down in all major economies. This takes some time to work, but then usually investment consumption is picking up. So you will not be surprised that, for instance, for the euro area, growth expectations for next year are even better. Don't get me wrong, the winter will be disappointing in Austria, Germany, recession still continuing over the next months, but in the course of next year, even here in the heart of Europe, we should see an uptick in growth. What else is positive in 2025? Well, inflation, which has come down tremendously, you see it in the next slide, from roughly 10% now back to 2%, which is the target of the central bank, is expected to remain around those levels, so right around the target area. Even in Austria now inflation is back to roughly 2%. This gives ample room for central banks to continue cutting interest rates. We don't need inflation to drop further. If it just stays where it is, there's room for central banks to bring back interest rates to normal levels. And they are not there yet. Take euro area, we have started at 4% interest rate level, which was weakening the economy. Now we're down at 3.25 already, and the majority expects the central bank to cut further to around 2% by summer next year, 2025. And this, of course, adds momentum then over the course of next year to the economy as financing gets cheaper. Bad news, of course, on your savings accounts, interest rates will come down further as well, so there's less money to be earned there. And also on the bond market, the yield level that you can lock in by buying a bond over the maturity of the bond has already come down as well. I have an example here. That's the average yield you can earn on an average corporate bond in the euro area, which was above 4% starting 24, is now down to slightly above 3% already. But honestly, this is still better than inflation rate, slightly at least, and this is still better than the key interest rate of the central bank. What's the recipe for higher future returns? Well, at least historically, and I think this will be the same over the next years, you need equity market exposure to some degree, well diversified, with all the risks going on with this, higher volatility, higher risk of capital setbacks. But historically at least, equity markets, at least addition to a portfolio, was what has brought the performance. And here, if you just sum it up, the outlook for 2025 is still quite supportive. Economy growing, company earnings therefore also rising next year in my view, and at the same time interest rates still coming down a little bit further. But haven't equity markets already risen too much because of these future expectations? I won't be that negative. Well, let's look at the data. We looked at the broad equity index over the last 50 years. You see the nice long-term uptrends because company earnings have been growing over the years, and the strong volatility, of course, in between. And whenever the equity market made a new all-time high, just as recently, we put a green dot. So the green areas are new all-time highs. And you might see it was not negative for the market to reach a new all-time high. Actually, when you look at the data more closely, the performance over the next 1 to 3 years, after equity markets hitting a new all-time high, was even above the long-term average. There's usually a trend in the data. Once the outlook, the economy improves, company earnings are rising for more than just 1 year. So all in all, I think the outlook for 25 is not bad. There will be, of course, plenty of risks, some corrections in between, for instance, because of some Trump policies, but the fundamental outlook, that drove equity markets in 24, and I think will also dominate in 25, is economy still growing, company earnings still rising, interest rates coming down at the same time. Usually this has been a supportive recipe for equity markets as well. So I wish you good luck. Don't forget to like us, hit the bell. See you again next year.